All right, let's dive into First Watch's latest earnings. It's a really fascinating one, because at first glance, the numbers looked, well, pretty rough. But the way the stock reacted, that tells a completely different story, one that goes way beyond just the headline numbers.
So this is the big puzzle we're going to unpack today. First Watch straight up missed their earnings target. I mean, not by a little, by a lot. And you'd think the stock would get punished for that, right? Nope, it spiked. So what on earth did Wall Street see that made them so excited? What did the rest of us miss in those first headlines?
Okay, so here's that paradox in black and white. On one hand, you've got their profit, their earnings per share, coming in at just 3 cents. That's a massive 57% miss. Ouch. But then you look at the other side, and their revenue, the total money coming in, was almost $308 million. That's up over 19%. So yeah, a big miss on profit, but a really solid beat on growth. Two totally different stories.
And boom, this is what happened. The stock just took off, surging over 14% before the market even officially opened. Look, that's not just a small pat on the back. That's a massive vote of confidence from investors. They were basically screaming that they did not care about the short-term profit hit. They were looking right past it because they saw something much, much bigger.
All right, let's peel back the layers here. Time to dig into the numbers that got everyone so fired up.
So if we look at the key metrics, you can see the story start to come into focus. You've got the profit miss, you've got the revenue beat, we've covered that. But look down at the bottom. That's where the gold is. Same restaurant sales, that's up 3.5%. And the most important part? That growth came from a 2% increase in traffic. That means more people are actually walking in the door. And let me tell you, in this kind of economy, getting more foot traffic, that's a huge win. It says your brand is really connecting with people.
So where did that profit miss come from? Right here. Their margins at the restaurant level got absolutely squeezed. They dropped by more than 3 full percentage points. And the villain in this story? Inflation. The cost of everything, eggs, bacon, coffee, you name it, was way up. Now management made a really interesting choice. Instead of just jacking up menu prices, they decided to eat a lot of that cost themselves. That protected the customer, but it definitely dinged their profits for the quarter.
And this, right here, is the absolute heart of the story. The market looked at all this and said, you know what? We don't care about the temporary margin squeeze. This report isn't about that. It's about a real, positive change in how many customers are coming in. The bet investors are making is simple. Rising food costs are temporary, but a growing loyal customer base, that's built to last.
And this wasn't an accident. This focus on traffic is a deliberate part of management's long-term playbook. It's the exact strategy investors were cheering for.
Yeah, management was not shy about this on their earnings call. This quote really says it all. We're not just talking about a little bit of growth. This is the best traffic they've seen in over 2 years. And it was actually picking up speed during the quarter, with June being an absolutely fantastic month. It's a massive signal that their strategy of focusing on value and the customer experience is working. It's really, really working.
So here's their game plan, laid out nice and simple. Step 1, expand, and expand aggressively. But the real genius is in step 2. They are making a conscious choice to put customer traffic first, even if it hurts profits in the short term. They're absorbing those high costs instead of just passing them on. Why? Because they're playing the long game. The payoff comes in step 4, when they expect to get those margins right back as their own costs come down later this year. And believe me, when they say aggressive expansion, they mean it. This isn't just talk. During this past quarter, they hit a huge milestone. Their 600th restaurant. Think about that. They opened 17 new places and bought another 19 from their franchisees, just in Q2. The CEO put it perfectly, they are basically opening an entire regional chain's worth of restaurants every single year. That's just wild.
And they're being super smart about how they grow, too. Almost 40% of their new spots are what they call second-generation sites. Basically, they're taking over buildings that used to be other restaurants. It's a brilliant move, right? You get great real estate, you can open way faster, and you save a ton of money on construction costs. It's just efficient.
So with all this momentum, management felt confident enough to actually raise their guidance for the full year. And get this, they did it even with that profit miss in Q2. They bumped up their forecast for something called adjusted EBITDA, which is a really good way to look at their cash flow. And how can they do that? Well, they see their food costs starting to come back down to earth, they expect that strong customer traffic to continue, and they know all those new stores are going to start contributing in a big way.
Okay, so let's put it all together. What's the big picture now? What's the story that investors are really latching onto for the future?
Which brings us right back to where we started.
Was the market right? Did investors make the smart move by looking past that ugly profit number and betting on the growth story instead?
Our take? We agree. That's why we're giving First Watch an outperform rating.
So why outperform? Well, our bull thesis, which is just the argument for why we think the stock will do well, really comes down to three key things. First, that positive traffic is the ultimate sign of a healthy, growing brand. Second, we think the worst of that margin pain is behind them. And third, that incredible pace of new store openings gives them a super clear roadmap for growth for years to come.
All right, so with that in mind, what's the actual trade idea here? What should you be watching for?
The pitch is pretty straightforward. Go long ahead of the next earnings report in Q3.
Okay, here's the thinking behind it. The story right now is about growth despite bad margins. The bet is that next quarter, the story is going to shift to growth with great margins. The Q3 report is the big catalyst. If it shows that traffic is still strong and that the profit margins are bouncing back as costs like eggs come down, then we could see a big re-rating of the stock. That's when the market fully buys in and says, okay, this is a fantastic long-term growth story. It's really a perfect example of why you have to look past the headlines to find the real story.
And just a quick reminder, as always, this is for informational purposes only. It is not financial advice.